I was reflecting on my day last night, and I was actually thinking nobody that I know of had a worse day than whoever messed up the IRS website yesterday. And that tells you about how prepared the IRS is for what's coming down the pike for this year. But it was a huge reform, and it was a massive push for our industry to really act on this. And so I'm looking forward to talking with you about it today. And I would like to have some conversation about it because I do think there are some questions. So we'll do a little bit of download, but hopefully we'll have some dialogue as well. Here's all of my contact information. Always feel free to call, email. I know there's some schools who might not be NAIS members. It's okay to reach out to me too. By virtue of joining this webinar today, I have a couple documents that are, they're sort of, you'll get these slides, but they're also a couple synthesis documents that'll help pull this together so you can see it all in one place if you haven't seen those yet. We're going to talk a little bit about where to find things, the process that we went through, and just some of these really big chunks of the new tax law. This is the NAIS website. If you click on Learn, you go to the Knowledge Center, and you go to Legal and Legislative Resources. This is what that page looks like. And then we had the NAIS Action Center. I don't know if any of you got to participate in this, but this is what we use to really help schools do outreach to their federal representatives to speak up on the tax reform issues, because this unfolded so incredibly fast. I've been with NAIS, it'll be 18 years this summer. I was originally hired to do regulatory work, and I've never seen legislation move as quickly as this legislation did, particularly one that impacts our industry so fundamentally. So the House approved its bill on November 2nd. The Senate approved its bill on December 2nd. The conference bill passed both chambers on December 20th. So if you just look at that alone, and you think that Thanksgiving was in the middle of that, this moved through really quickly. And then the president actually wasn't even going to sign it until the beginning of 2018, but he signed it on December 22nd. So that was an incredibly fast turnaround. It was less than 2 months to move through arguably the biggest tax reform that we've seen in some categories since like about 1917. And nobody actually knows, I don't know if any of you have been tracking the numbers, how this is going to affect our deficit yet. The deficit numbers keep kind of rolling out, and the Republicans are a little bit concerned about that right now because Paul Ryan has just announced, obviously, that he's not going to run again. And there could be some splashback from this. But either way, I'm so proud of our industry. We sent almost 5,000 letters to Congress. Tuition remission and that educational assistance piece was a huge overriding issue for our schools. Most of our schools provide a benefit, and you might be doing it a little bit through financial aid or straight up tuition remission. But this is when we give employees a discount on sending their students to our schools, or when we provide them with funding to carry on their education. So this would have been a huge blow for us. I think our Stats Online data shows something like 86 to 90% of our schools provide some level of tuition assistance. Charitable giving was a huge issue. We didn't do as well there. Tax exempt bonds almost got taken away, and then employer provided housing almost got taxed, which would have been a big deal, particularly for our older schools with big heads houses on historic campuses. So this is just sort of an overview of the process that we went through. I'll tell you, when the House bill first came out, it was October. I think it was like, no, the House approved bill is November 2nd, and I was in Seattle and actually writing up an overview of that bill in a hotel room in Seattle because we knew it was going to move so quickly. We did a lot of work with partnerships. We worked with NBOA, a lot with higher ed. There's a whole bunch of charitable giving coalitions that we worked with, and we sent a lot of letters up there. So let's start with the basics. Because there was so much noise and the two bills had some conflicting provisions in it. So what stays exactly the same? Tuition remission has not changed. And again, for our schools, this would have been a huge rollback. We were very fortunate. The National Review happened to pick up on our issue, and I still have no idea how this happened, but they ran an article on it. Not just about, they actually didn't even mention the college grad student piece of it because they also use this provision, but they said specifically in private schools, this is such an important piece of the benefits for teachers who work in private schools. Employer provided tuition assistance. This is when you give employees, I think it's $5,250 a year for them to continue on their education. and that's tax-free. Housing was going to be taxed, once a head of school in particular or another highly compensated employee reached above a certain level. The housing benefit was going to be taxed, it kind of was a sliding scale. And that was mostly aimed at higher education. We would have been caught in that net. Housing stays exactly the same. So the same benefits laws that we've had in place for the last, 25 years, those remain in place now. The teacher supply deduction, this is when teachers, fund out of their own pocket. They can still take a deduction for $250 a year. The Senate was trying to make that more generous. The House was trying to take it away, but that remains exactly the same. Flex benefits remain exactly the same. I know a lot of our schools do that. Employer-provided childcare was also going to be a taxable benefit, and that remains the same. A lot of our schools have early child care centers and things like that to, both to bring in extra funding, but also to provide that benefit to employees. And so that remains exactly the same. Coverdale accounts at one point were also on the chopping block. Those remain exactly the same. Tax exempt bonds, and this would have been huge. The House bill was going to take tax exempt bonds completely off the table. And I don't know of many independent school building projects that don't use tax exempt bonds. Same with hospitals, libraries, a lot of municipalities that have these little incorporated nonprofits. Tax exempt bonds are still in the mix. Mortgage deductions, those were going to go. They were going to go away, then they came back. They still exist. It's just up to $750,000 now. And the important piece to note on that is home equity, if it's used for tuition or anything other than improvement of homes, that amount is no longer deductible under the new law, but mortgage deductions are still there. And the medical expense deduction for schools that are either LD schools or you might provide additional services, through an accommodation center or resource center that you charge extra for. Under tax law, a lot of parents can deduct that. That was also going to be struck down in the House bill, but it still exists, and it's actually going to be more generous for 17 and 18, which actually reminds me. Everything I'm about to talk about, the start date on all of it is January 1st, 2018. So the tax year that we're in right now, which is going to be difficult for a few benefits issues because most of our schools, obviously we run on that fiscal calendar for our school. So most of you have books that close at the end of June. But when you're looking at anything employment or benefits related, it all kicked in as of January 1. So important note there. So these things stay for the most part exactly the same. Things that disappeared, they kind of came up through the various bills and a few amendments that were thrown out there. The House actually had a really interesting piece that was going to provide a clarification on the difference between employees and independent contractors. That disappeared. I was sort of sad about that because that would have helped a lot of our schools, particularly when you're looking at coaches or part-time staff or others who just come on and provide support services on campus. At one point, there was going to be a religious instruction tuition deduction that also got taken out at the last minute. So that was no longer there. The IRS actually had a wish list item on changes to intermediate sanctions, which would have generally been bad for nonprofits. That was also taken out. It never showed up in the Senate bill and did not get adopted in the final bill. They were going to try to get unrelated business income tax on logo royalty. So if a local business wanted to use your logo or sell your logo products and license your logo, right now you can do that tax-free. These bills actually would have made that taxable, but that was taken off the table. And then there was a Johnson Amendment repeal. The Johnson Amendment is what keeps nonprofits from being able to raise issues during political campaigns. It keeps nonprofits from being able to be truly politically involved, particularly during campaigns. That was originally in some of the original bills, and that was taken off the table. So all of these things in front of you, if you're still worried about them, if you're still thinking about them, if you heard about them, wondered what happens, they're all gone now. So I want to start here because this is probably our biggest wild card in the mix. This is the charitable giving effect and what's happened with personal deductions. I know tax issues are scintillating, but this one in particular could have a huge impact on our schools. What this tax law did was it increased the standard deduction, it basically doubled them, and it eliminated personal exemptions. It rolled back state and local tax deductions, so whether it's property tax, income tax, sales tax, it's all the way down to $10,000, and you cannot take a deduction higher than that. And then they rolled back that mortgage interest deduction again down to $750,000. The combination of this, and if you're looking for a tool that helps you sort of figure out what this looks like in practice, and New York Times has one on their website, is that the raising of the personal deduction and the shrinking of the state and local tax deductions and the mortgage interest deduction has made it so that more people are likely to take that standardized deduction than to itemize. This is really important for us, of course, because we do the charitable deductions, right? So when people give money, you send them a letter and they can take that charitable deduction when they itemize. Now a lot fewer people are going to be itemizing. At least that's what we anticipate. And this is something we fought really hard for. Our school sent in almost 1,000 letters on this issue alone, is that we're going from about a third of people itemizing to about 5 to 8%. So it's about 28 million people. And what the nonprofit sector is worried about is that bullet above the wild card highlighted one. This could be a reduction of $13 billion a year in charitable giving, which is a huge dollar amount. And for our schools, if your giving tends to come in a lot of smaller gifts, this could be a big impact for you, because that, I'll go back here, that $24,000 standardized deduction, people are on the fence until about $450,000 to $500,000 in a lot of cases. So that professional band of parents that you have could really be looking at a standardized deduction instead of itemizing. The states, of course, are a little bit upset about this. This is rocking some property values in some areas, places like New York, Connecticut, places with really high property taxes, particularly like in New York City. States are looking to say, well, how can we make this better for employees? So some of them are really looking a little bit more closely at employer payroll taxes, because for employers, they can still deduct the taxes from their taxes, as opposed to having the employees paying the taxes. So can they reverse that? So that's something to watch on the state level. And then there's this other weird piece, and that wild card is a live link, and so it explains these issues. There's a theory out there that it could be a charitable contribution of property or other taxes. I don't know how that would work truly under charity laws, because you need that donative intent, but that theory is rolling around out there. But that's going to be a pretty big impact for our schools, particularly, again, if your school does, gets a lot of gifts that are in that, less than, $30,000 range, you could be seeing some issues here. What we know people are talking about, and again, these are live links, are that people might be bundling. They might decide to give basically twice as much one year so that they itemize that year, and then they don't itemize the next year and do the standard deduction. There are some schools that are really looking more closely at donor advised funds, and the donor advised funds and distributes a little bit differently to charitable institutions over time. And then other people they're sort of doubling down on charitable IRA rollovers, because these are still open for schools. So the distributions to the charitable institutions are not taxable as long as it's going to a charities, and you don't need to itemize those. So those are three possible approaches that schools are looking at. A couple other wins and losses here. There is an increase of the deduction for those who are itemizing. They can go up to 60% of their adjusted gross income for cash gifts. And there's a repeal of the overall limitation on itemized deduction for those itemizing. We were really lobbying for a universal charitable deduction that could be used, in concert with the standard deduction. So this would be, wouldn't require itemization to use it, but that did not gain ground. And then the other thing we're a little bit worried about is the estate tax exemption has doubled to $22 million for a couple. And so there's less incentive for end of life giving. So I want to pause there for a moment and open this up to questions, or if anybody would like to share what you're doing with your school on these fronts, or if you've started really thinking about that. And you can unmute yourself if you want to speak up or raise your hand. Anyone? Anyone? Everybody's afraid to say something? Are you horrified? How many of you have started planning for this already? You can just nod your head. How many of you have no idea what's happening at your school on that front? All right. I won't pick at you anymore on that one.
Remember, just to answer a question or ask a question, all you have to do is unmute your microphone, lower left-hand corner, little microphone icon.
Yeah. And there are only 25 or 26 of us on the call, so it's not, you're not talking to the masses. So, but
Deborah, I assume at some point you're going to also talk about the 929 accounts and that people can use them now for private school tuition, because that could be the offset to some of this disincentive to give, because there's going to be a tax benefit for people paying tuition to private schools. Exactly. I don't know how schools will market that, but that's what I've been wondering, if that's something we could utilize in some interesting way.
Yeah. Then I will keep moving ahead, and we'll hit a couple other high points, and we will talk about 529 plans, because that does seem to be where people have most of the questions. So moving away from charitable giving, looking at unrelated business income, and particularly as it relates to benefits. The other interesting thing that happened here with the tax bill is, for the first time, they said that if a school provides certain benefits, we have to recognize unrelated business income on the value of those benefits. Basically because they took away the deductibility for for-profit entities to deduct those benefits. And what they said was they're trying to level the playing field of benefits between nonprofits and for-profits. So I don't know about the rest of you, but if I look at my for-profit colleagues in law firms and my nonprofit salary, there's a pretty big difference already. So I'm not sure why this was necessary, but there it is. I would note that these top three, the transportation fringe benefit, the on-campus gyms and athletic facilities, but note incidental use of school facilities won't count there. And then there's this weird parking valuation piece. Those are the only ones where you've got to recognize unrelated business income. These other things that they've made less deductible for business, or they've done sort of weird things to, in the tax bill, they do not trigger unrelated business income. So it's not a huge deal for our schools. We don't really get into deductibility this way unless we've got sort of a wholly owned subsidiary, which is a different animal. But those three are the only ones that we're worried about right now from a nonprofit perspective. Now taxable, so moving expenses, that's something you've really got to watch. A lot of schools will provide this, particularly if you're moving administrators around. So if you've hired a new assistant head of school or head of the upper school or whatever it is, a lot of times we'll provide moving expenses for that, or it might be like up to $5,000 or something. That's going to be taxable at least through 2025. And then there's this bicycle commuting cost thing. An interesting development, again, that doesn't affect us too much because we don't use tax credits quite the same way, is this parental leave tax credits. And there's at least some speculation that this area is sort of scooching the federal government to some sort of mandated paid parental leave. We already see this in some states or some localities in a little way, but it's interesting that from a policy perspective, the federal government's pulling on this lever a little bit and playing with it, at least to incentivize paid leave of some kind. What can be a big deal for our schools, and again, I think this is aimed more specifically at higher education, is a 21% excise tax on the school for compensation in excess of $1 million paid to any one of the top five highest paid employees. And again, this really is pointed more towards higher education and athletic coaches, but really be careful of this if you've got a head of school who might be retiring soon, and there's a lot of 457Fs and other things rolled in there. they can start to ooch up into that $1 million range. So you've got to be ready for that excise tax piece. This is also true with parachute payments. I've never seen a parachute payment this big from our schools. I'm very happy to say that. But if you see a parachute payment and you're paying somebody out and it's 3 times that base compensation, be ready for that too. Retirement issues, you might remember they were kicking around actually getting rid of retirement contributions, pre-tax retirement contributions, and that never moved anywhere. IRAs, you can still roll things over to a Roth, but you can't come back from a Roth to a traditional. And disaster zone residents, this won't apply to you unless you've got somebody, who's got, a house or whatever in any of the disaster zones. But they can take out a $100,000 penalty free from IRAs and retirement plans. That's part of their attempt to fund some of the disaster relief. This is more of a policy issue, and again, the deductibility doesn't work for nonprofits in quite the same way. But this was interesting, again, from a policy standpoint, in that the tax bill basically says if you have a settlement or some kind of a severance agreement with an employee that has a non-disclosure and it relates to claims of sexual harassment or sexual abuse, which again is really important for our schools, there's no deduction, and there's no deduction for attorney's fees. From a policy standpoint, this is interesting that the federal government is getting into this, and you might start seeing something like this on the state issue too. We're seeing this already come up with arbitration agreements and such, at least from a social media political pressure point of view. So just know that's kind of out there. Another piece of this is if you have a unrelated business income tax, and this is generated usually when a school is doing something that's a little bit outside of its mission, and you're doing it regularly enough to get a fair amount of income from it. So regularly carried on, not substantially related to furthering your exempt purpose. This can be like renting out a piece of your campus regularly for weddings. It can be camps that have nothing to do with your school. It can be just triggered in a few different ways. So when you've got those business pieces, I know of a school that actually has an oil well on campus. Historically, you've been able to bundle those together, and you've been able to offset the gains and losses from all of the businesses within that category. Now the IRS is going to be looking for you to separate those out into separate categories. And nobody actually knows what this means. The IRS is supposed to provide guidance on this by the end of June, so we'll see something on this pretty soon. But they're going to be looking for nonprofits that have different businesses that fall into this category to segregate those gains and losses into specific businesses. One of the pieces of tax advice that I've seen floating around out there is that nonprofits might want to create a single corporate subsidiary to just pull all that back together again to work around the tax law. I don't know if that's going to work or not, but again, this is going to create a lot of complexity for schools that have a lot of little things that are generating this kind of income. So there might be a simpler way to do that can help your school. But just be aware of that if you've got that unrelated business income. Again, we still have tax exempt bonds. There is a limitation on refinancing. You cannot do the advanced refunding, which is basically like an early refinance, but you can do that. You can still do the tax exempt bond. So that was a big sigh of relief for everyone. But for loans generally, if you have an outstanding loan with a bank, note that there's a change provision in many of your loan documents that allows the bank to adjust the interest rates if interest rates are changed within the tax code or have that effect. So you could get a notification from your bank that they're messing around with your interest rates on loans that already exist. So be aware of that. Look out for notifications from your bank. Don't ignore it. As far as I know, these haven't gone out yet. I've talked with a few business officers in different parts of the country, and I've talked to a couple of bank people too, and they sort of said nobody wants to be the first out of the gate on that. But you could see that coming, and just know that there could be some movement there in any direction. So before I move into 529s, does anybody have any questions on any of those issues?
Hi, Deborah. This is Joan Dannenberg at Trinity.
Hey, John.
As a larger New York City school, I do think about this 21% excise tax. So the definition says it's taxable wages except retirement plans. Does that mean that you can deduct whatever an employer puts into a 401A plan, or if the employee puts into a 403B?
You know, I'd need to look at it a little more carefully before I answer that, because there hasn't been a ton of guidance on it yet, and that's literally all it says.
Right. I keep asking, but no, I haven't gotten a definitive answer yet.
Yeah, we actually, Whitney Silverman's our staff attorney, who I adore, and we have like a punch list of things we're keeping an eye out for, and that's one that we've got out there. And kind of what we do is we just sort of do this regular scan to see if anybody has come up with any bright ideas about how some of this is working. But I haven't seen a lot of clarification on that yet, and so that's one that we're kind of looking at. I'm happy to look at it again just from the code, but the last time that I looked at it, I'm still pretty much in the same place that you are, in that I'm not confident enough one way or another, which is kind of scary because we have heads who are retiring soon, and we need to know the answer to that question. Yeah.
Right. Okay. Well, at least I'm not alone, so thank you.
No. No, this is all about group therapy on this call. There are no dumb questions, and if you think you have not learned something that you're really looking for, there's a good chance that there is no answer to it yet.
Okay, thank you.
Of course.
We had another question from Katie.
Katie.
Okay, I'm like muting the wrong thing. I apologize. Hi, Deborah. Thanks. So 2 things that you kind of mentioned quickly that I know nothing about in regards to this is that you mentioned the paid family leave. I didn't follow what you said about that. And then the other thing was like the sexual harassment and the non-disclosure agreement. I missed the points on those.
Yeah, so you don't even really have to worry about them, particularly from a tax perspective. It's more from a policy driver perspective. Right. So with the tax credits and for parental leave, it's actually only for 2 years. I think it's for 17 to 18. Like it's a pretty short period of time, but it's basically incentivizing employers to provide paid leave for employees. And it's something the federal government has been talking about. You guys probably know this on the call just because we're all in the education space. The United States lags so far behind people in terms of mandatory paid leave in terms of other countries, the richest countries in the world. It's embarrassing what number we are. So what we could be seeing, this could be sort of a policy movement into either further incentivization of paid parental leave or potentially mandatory paid parental leave, because that has been kicked around a little bit from a policy perspective. And it's really unusual for something like this to come from Republicans. And make no mistake, this is all a Republican bill, but Democrats had almost nothing to do with this. So it's an unusual piece to see from the Republicans. So we could see movement going forward on that front.
So we're in New York, so it's already happening, right? Okay, so it's nothing more than what we're already dealing with.
Right, okay. Exactly. And then on the sexual abuse and harassment front, it's more of a statement about policy-wise where the federal government is, particularly on sex abuse. And many of you know, they recently passed basically a sex abuse law for organizations like U.S. Olympic teams that run across state lines for mandatory reporting. And so this is sort of another statement both on sexual harassment and sexual abuse about sort of as a policy, raising that as a priority to not be shoved under the rug, which is something that as an industry we watch pretty carefully, particularly given the number of claims that have come forward, particularly since Penn State, when we really saw a waterfall of old sex abuse claims come up. And there's a lot of questions that have surrounded the settlement agreements that schools and other entities have struck with survivors. So from a policy perspective, it's just something that we're watching from the federal government.
Okay, great. Thank you.
Yes. Anybody else? All right. Okay. You have had 3 parent phone calls about the new 529 language in the tax bill. Parents want to know when they can start sending payments in from their 529 plans. What if grandparents from another state want to start making payments from their plans? What is the current state of the law? Should you be including these plans in financial aid considerations? And what do you do? Does anybody want to take a crack at this before I start walking through it? I see a lot of head shakes. Okay, let's see some hands. How many of you have started getting payments from 529 plans? Yeah, at least one. Let me go back to the other page. How many people? Anybody? Anybody gotten questions about it from parents? Yeah. This is probably the biggest issue that's shown up in here. And it was so funny. I had some friends reach out and say, you know, congratulations, you guys did a great job getting this in the bill. And I would love to say we had anything to do with it, but Ted Cruz just kind of threw this in sort of randomly. And interestingly, he's from a state that has no state tax benefit from this change. So 529 plans, just to make sure everybody's on the same page, they're historically, 529 plans can only be used, the money that goes into them, only be used for qualified higher education expenses. So, you know, they're feeling wild and wacky, and so they added into the definition, including up to $10,000 of private school tuition. And it's per child and it's in the aggregate, right? So if you have a family that has 3 kids at your school, they're generally beneficiaries of plans, and they can get up to $10,000 paid for out of 529 plans, but per child. So those 3 kids have $10,000 each. $5,000 can come from a grandparent, $5,000 can come from an account the parent owns, and it can be like that for each child, but it's $10,000 total. From a federal standpoint, it's a pretty, you know, 529 plans are pretty easy. The investment income just grows tax-free as long as it's used on those expenses. So if when a child is born, or you can even do it actually before you're even pregnant with a child and just name a different beneficiary and then change the beneficiary. So say you put in $20,000 when you're pregnant, and then, you know, 18 years later, you're using all of it for that freshman year in college, there is no tax paid on that income from the investment. So say you made $5,000 in that period of time, that's tax-free growth as long as you're using it on qualified higher education expenses. So now you can use up to $10,000 per child per year for each student. So, and note, there's not a federal deduction for this. So from the Fed perspective, that's pretty simple. It gets exciting when you've got the states. So 33 states, including New York, have some form of a deduction or credit for parents when a contribution is made. And so you can have grandparents in other states who can fall into that. In South Carolina, it is an unlimited deduction. And so grandparents can actually combine gift tax things, and you know, so they can make a huge gift in 1 year, combining up to 5 years of that gift tax piece, and they can use it to pay tuition in New York. So it can come from any place. So you've got to be aware of New York law and kind of how that affects, but also know that, I mean, and basically, I mean, let's call this what it is. We're laundering money through state tax deductions and tax credits to get that deduction, right? So in South Carolina, with that unlimited deduction, that $10,000 leads to a $750 deduction, or total actually credit on your tax returns for the state. So it's a huge offset, and you can do that year over year. What they didn't think about is the IRS has never actually had to track this quite like this, right? So this is a dollar limitation amount per child, and there is no system that really tracks this like this. Right now, colleges do some reporting to the IRS, but it's in the context of other tax credits and other pieces. So those forms are not really appropriate for us to use, and they don't apply anyway because we don't take federal funds. So there's no mechanism in place right now to verify this, because 529 plans, they can pay out directly to an educational institution, but they can also pay out directly to the owner of the fund, who can then turn around and use it for the expenses. So there's a little bit of an honor system going on here, and the IRS doesn't have any way to cross-reference this on the back end. So from an IRS perspective, this is pretty difficult to pull off. The benefit of this, particularly for grandparents, is the owner maintains control of the account, and it can be anyone. The beneficiary is the student. There's no limit on your deposit unless the plan imposes it. Each state has different plans. I think there's like 128 different plans in the United States, and most plans don't have a limit on deposits. And again, this is the tax piece that I was mentioning. Withdrawals for most accounts, there's no minimum time that the dollars have to stay in the account. So a parent can deposit the money on Monday, pay the tuition bill on Thursday, and Bob's your uncle, you've got that tax credit from the state perspective. You don't have any federal benefit because there was no growth during that time, but if you're just leveraging that state tax benefit, there you are. The plans are individual. So in different states, you may need to tweak the policies and processes. I think in New York, at least I think my last understanding was that you're pretty clean right now. But the state laws in different states have to be tweaked. So if you've got grandparents who are calling you from different states and saying, hey, does this apply to me? Don't provide them with direct tax advice, because different plans have not come out and said whether it applies in the state level or whether they'll take these payments. The other question I get, and somebody asked me this today, this generally does not apply to pre-K tuition. The understanding is that it's for K-12 tuition, so it's not for your 2s, 3s, and 4s, just given the standard definitions related to education. So be careful of that. You can have a state clarification that might allow for that on the deduction front. The one piece that people really need to be aware of is that deductions can be clawed back if they're taking improperly. So if you've got grandparents giving from a different state and they take that tax deduction and they shouldn't, the state can come back and reclaim that. There's still the most value for long-term growth. So, you know, I think it makes sense to leverage that state tax law, but ultimately if they're putting money in 529 plans for long-term growth, it makes sense to keep it that way. Watch for 529 guidance from financial aid providers. I'd be interested to hear if the New York plans have put out some kind of guidance on this front for what they're doing and how that's working. If they have not, it's probably a good idea to come together and get one document that you can all use with parents and grandparents so that they understand how this is going to work. Okay, so let's talk about this for a minute because I'm sure there's some questions. Here's one that was typed in. We have a parent who does not want 529 calculated in because the plan was always for college, and now we could be impacting their college savings. How have you guys dealt with this from your school's perspective? Anyone? Yes, Matthew. Anybody?
I'll say we haven't, you know, we've kind of talked, are we including it or not? I think at this point, we're leaning towards, you know, great for them if it's something that they can take advantage of and use it. But I don't think that we are looking at making a financial aid decision based on the fact that they have access to these at this point.
Yeah. Anybody else kind of kicking around that option? That's what I've heard the most from schools, and when I've talked to Mark Mitchell about this is generally where we've ended up. As you probably know, we're still stewarding the SSS methodology. So I know they're looking at ways that if schools could potentially include it or look at it, that you might, but from a policy perspective, when I've talked to a lot of financial aid practitioners, I'm on the board of one school, it's they're reluctant to dip in too much to college savings because some of this tax law has also made colleges more expensive, particularly given the tax on endowments that some colleges are going to be facing. Other questions on this?
I was very disappointed I couldn't use the 529 funding to send my kids to high school until they went to college, and then I was pretty glad that I wasn't able to use it.
Yeah, and unless there's a state, I mean, you know, unless you can use that state tax credit or deduction, that long-term growth is still going to be where your best bet is. Although I'm sure all of you are in the same boat, watching my retirement savings get gutted over the last, I don't know, 6 weeks. Maybe using that, in February would have been a better idea. But it's definitely, it's one to watch, and we're just not sure exactly how it's going to shake out yet. But be careful with the tax advice on this front, and just know that grandparents are going to be coming in. We do expect guidance from the IRS on this, particularly on that tracking piece. So make sure that you're doing this already. I mean, most of you are on electronic billing cycles and all of that stuff, so that parents very well might be the ones who have to prove up where those payments come from, or grandparents are going to have to. I don't know how the IRS is going to cross-reference it. They might very well have some kind of form that our schools are going to have to fill out if they're taking payments from 529 plans. So we're looking for more guidance on this, but from an IRS perspective, this is going to be really hard to administer because the plan wasn't really designed to do this exactly. And the states are fascinating. In some states, the law is very clear that yes, people can use the 529 plans this way. Yes, they get the state tax deduction. And the 529 plans have said, yes, we know all that, but we're actually not changing any of our materials, and we're not going to advertise that we'll take those funds that way. Which is not exactly the warm group hug that we were all looking for, but there's a lot of weirdness happening out there in the field on this front. And actually, I have a piece from Mark. George, I'll give it to you, that really gets into thinking about 529 plans and how it fits into the financial aid picture. So I'll provide that when I send you the slide.
Great, and I'll forward that on to everyone. Thank you.
Okay, so look for a lot more guidance there. Other bits and pieces that came into the tax bill. There is the Affordable Care Act. The individual mandate is rolling back in 2019. This could really trigger yet more changes in our health insurance premiums and cost, and it could impact your health insurance pool. I would love to say it's going to impact it positively, but I've seen nothing impact positively health insurance premiums over the last, I don't know, decade or so. So just know that you could be seeing another big leap come next year for your health insurance premiums. And note the individual tax rates. And this is kind of going to play into charitable giving and just how much discretionary income some of your parent body has. Different kinds of corporate entities like partnerships and LLCs are going to have different kind of flow-through tax structures. And that's working well for some professionals, not as well for other professionals. For those of us who work for nonprofits or standard corporations, we actually take a little bit of a hit under this tax law. But your doctors, lawyers, accountants, those in true partnerships, financial advisors, they might actually end up ahead, so they might actually have more discretionary income for giving. So watch, just see how the shakeout works out for who are the winners and losers on this tax cut, because it could mean that some parents have more discretionary income for giving. The most important part for me on this is that this was a huge shot across the bow for nonprofits. The new tax on higher ed endowments, I think, is just an experiment to see how beneficial that can be to the federal treasury. A lot of our schools have some good size endowments, and it might be nice to tax a little bit of the interest that they've earned over time. So we're watching that pretty carefully to see if it comes back. The tax on high nonprofit compensation. I mean, basically, this is a policy statement that any nonprofit executive making over $1 million is making too much money. And so we really have to be aware of that, particularly in the big cities like New York. And I know the boarding schools are watching that pretty carefully too. And then we're looking for these other threats to come back again. We're going to keep eating away at benefits. How compensation is determined, that bond piece, although there was such a big pushback against that, I'm not as worried about that. They were attacking higher education tax credits, and if that rolls back, that just inflates the cost of education for everyone, and that royalty on logos. On the state level, what I'm hearing a lot about, and there's actually pending legislation in Massachusetts right now on this front, is this payment in lieu of taxes and services in lieu of taxes, particularly on the property tax considerations from states and local governments. And I pretty much consider these, they're almost muggings when your township says, hey, you use a lot of our services and you're property tax free. And so now we would really like you to pay us to help offset these expenses of the use that you put into our schools. So from a school perspective, if that hasn't happened to you yet, know that it might be coming down the pike, and you really want to look at, you know, your community impact statements in a positive direction. Lawrenceville and ETS actually got together years ago and did some proactive work on this in sort of the greater Princeton area, because they were worried that this was coming down the pike in Princeton. And sure enough, it has. I'm sure many of you have been following that drama that's just happening one state over. So just be ready for that. We're going to do a legal symposium with tabs next October. It'll be about 2 days. And I actually have a friend who does work specifically in this area for small colleges and schools to talk about how do you get ready for dealing with a pilots and silots issue. So if you have any interest in that, that might be something to look forward to. So watch for the state level activity. This is a big hit for state budgets, just changing the federal tax rules. So I know some states have been really active in this. We're really watching for the updates on IRS guidance and forms. We expect a big chunk of it to come in June, and then to be sort of dripping and drabbing out through the summer. Note the IRS is not staffed for this at all, so they're trying to staff up to move this forward. If you've got unrelated business income structures, really work with tax advisors to make sure that you're doing that the best way possible. There are going to be some issues that need to be fixed legislatively, and right now the federal government is not inclined to get into tax again. So I don't know how that's going to work out, but it's something that we're looking for. So, you know, keep watching. We do the Washington Watch. We write it up every 2 weeks, and that's where we'll pull a lot of this together. But we also have a tax reform page, which is where we'll be loading up a lot of this guidance so that you can kind of just keep an eye on that, and we're happy to keep you updated. So that, in simple terms, is the new proposed tax reform plan that we're all facing, coming right now to a theater near you. If I can be of any help, don't hesitate to email me if you're just looking for more information. We have a lot of resources, and we're pretty good at tracking things down, so I'm always happy to help. At the end of this is this cool tax changes summary grid. I think we have 3 slides worth of it. So what was in the House, what was in the Senate, what was in the final bill. So you've got that here, and I'll provide the summary documents, and I'll be happy to take any questions if anybody has any questions. I know you're so flabbergasted and excited by tax regulations and potential upcoming guidance that you're stunned into silence.
Hi, Deborah. This is Cece from Friends Seminary.
Hey.
And how are you? I have one question about the tax exempt, or was it just taxable, that the banks can now change, give notice and change the interest rate? I didn't quite understand what that tax law is that impacts the rate change.
Yeah, so it's just the fact that the corporate tax rates have changed, or that there's a change that can change corporate tax rates. And if you dig through your loan documents, and this is one of those fabulous areas of esoteria my husband deals with, and I'm glad that I don't, because he was like, oh yeah, I fight that every single time. But there will be a line in your loan documents, most of your loan documents, that permits the bank to revisit the interest rate because of changes in federal tax law. And so it's not a tax law in itself, but it's a contractual provision that subjects you to a potential rate change with your loan documents.
Interesting.
Yeah, no, that's really fancy. Yeah, I'm a little bit hurt.
Yeah, even if you have a fixed rate, there is that possibility that that's in there.
Yeah, so if you've got a big old loan sitting out there, it wouldn't be a bad idea to look at those closing documents and see if you've got something like that in there, just so that you know. And for you guys to sort of band together and give each other a heads up if you see a rate change with your bank. Because I bet a lot of you bank through the same, you might have like an area bank or two that does a lot of the loans for all of you. And so if they hit one of you, they'll probably hit more than one.
Thank you.
Yeah.
We have a couple more minutes if anybody has a question or two.
I do. I'm sorry, I don't want to cut anybody off. Am I good?
You are.
Yeah.
Go ahead.
So Deborah, I just kind of wondering, you know, it's, I feel like sometimes sitting in on things like this, it's like it's good to know more, but then I don't want to, you know, I'm surely not an expert after an hour webinar. And so I guess my concern is just with regard to the 529s and when people, you know, because we have had those questions and sometimes they come to me directly in the business office. Sometimes they're asking our director of admissions. And so, you know, we have students that come from different states. And so I guess it's trying to figure out what we share and what we don't, you know? And so I don't know if you have any kind of advice on that
Yeah,
I don't want to seem unhelpful when people are asking us, but I also don't want to, you know, I don't want to tell somebody something and then they get taxed on the money they send to the school and then they're mad at me about it.
Yeah. Yeah, I mean, I think, have the New York plans, have they put anything out, or George, have you guys put anything out on how 529 is working in New York?
I don't believe that we have yet put out anything new about how 529s are performing or changing in New York. We do have an eSeminar scheduled in a couple weeks with a New York tax expert who will hopefully have a little bit more insight. And we will, and I was going to mention this at the end regarding that type of question, Katie, we'll be posting any documents that we come across that would be helpful in the NYSAIS business officers Google site and heads Google site as well, because as Deborah mentioned, Mark Mitchell had put together something. And so as we find this information, we'll make it available.
And I guess, does it matter the state it's coming from and going to? Is it always where the origination of the account is, that's who they're subject to, or we're, right?
Yeah, exactly. So, so if you have grandparents, and this from a risk management perspective, ideally it's coming from one person so that your message is consistent.
Right.
Hopefully you'll get something sort of concrete from the New York State plans that you distribute so that, and it says exactly how it's working from a tax credit or deduction standpoint, you know, whether or not the 529 plans are even allowing payments that way, because a lot of the plan documents are individual. But then, you know, to have, you know, sort of your 5 points to grandparents or whomever from out of state saying, with your 529 plan, to make sure that there's not a deduction or credit clawback, that it works the way you think it does in your state, because you're not providing them with tax advice on that point. I think schools can probably reasonably, or, you know, if you're in New York City and you're dealing regularly with students from Connecticut and New Jersey, to know roughly what's happening in those states is probably really helpful. But, you know, if you've got grandparents who are in Ohio, you don't want to be tracking what's happening in Ohio so that it can really become their problem. So, but to make sure that's funneling in one place, or if it's you and the admissions person, like the two of you get all those questions, that you've got your bullet points and you know exactly what you're saying.
It's good advice. Thank you.
I have one more quick question, Deborah. This is Cece. Can you quickly maybe refer to what the changes are between the classification between employee and independent contractors impact?
Yeah. My favorite ones are, I actually, here's a horror story just because it's got a good governance twist to it too. So say you've got a head of school spouse who, let's say, has great website skills, and you recently launched your web guru or whatever, and so you start paying the head of school spouse, you know, per hour or per project to work on that. And so now we've got the head of school and the spouse, and there's a bunch of governance things that come into play. But over time, and it could be the spouse, could be somebody else, they add on more hours. So they might be teaching a class, or then they gain an advisory group, and then suddenly they're there 25 or more hours a week, and they've moved from sort of contract work on individual projects that they might be doing from home or on their own time to starting to look more like an employee. And when that happens, you've got to pay FUTA and FICA and provide certain benefits if they're triggering over 30 hours a week and all of those things. And this is exactly the kind of litigation I used to do. That's when the IRS gets really interested, or are they still an independent contractor, or are they an employee? There's a like 20-part test out there that the IRS has relied on for a long time. And what the proposed legislation from the House did was said, you know, basically if you have contracts with these specific points in them, they're definitely going to be an independent contractor, and we're really not going to revisit that again. So it would have been nice, because it would just make it a lot easier for schools from a contractual standpoint to say this is an independent contractor and this is an employee. You can still have litigation about it, but it would have been cleaner, and that just doesn't happen as much anymore. So anybody that you've got who kind of started just doing small projects or little pieces on the side, and their role has grown at your school, look to see if they're really truly an independent contractor or if they've become more like an employee. And I can send you a document that kind of walks through what those differences are and how to think about the test, if that's helpful.
So this is not new. This is just what we do in existence currently, just identifying and distinguishing between the two. So there is no say, oops, you don't have that anymore, and just continues.
Right, right. What they had teed up was actually a helpful change, but they ended up not passing it as part of the new tax law.
Thank you.
Yep.
Well, thank you so much, Debra, for your wisdom and sharing generously your insights and specific experiences with this. I think it's a moving target and an evolving set of issues that we'll have to track and follow. And thank you for helping us. As I mentioned, I will be sending the recording and slides from this presentation to everybody, in addition to the other materials Debra mentioned that she'll be sharing. So I want to thank you all for taking time this afternoon to join us, and welcome you back to subsequent eSeminars. As I mentioned, there's one on May 10th about New York State financing and tax law changes, and I will make sure to get out an announcement, a reminder soon on that topic. Bye, everybody. Thanks, Debra.
Bye, everybody. Thank you.
Thank you.